Hello everyone, welcome to week 1 lecture videos. Our today's topic is Introduction to Corporate Finance and Financial Mathematics. We'll be covering chapter 1 and part of chapter 2 today. So let's start with chapter 1, Introduction to Corporate Finance. We have a couple of learning objectives in this chapter. So I will be dividing this chapter into 3 parts. So in this video, I will be talking about different corporate decisions. So overall, in this chapter, we will discuss different corporate decisions. We will understand what do we mean by a corporation, the role of a corporation in the financial markets, functions of financial markets, and last of all, we will be talking about agency and problem and principal agent relationship. So first of all is corporate decisions, investment and financing decisions. A corporation to carry on its business requires an endless variety of real assets, for example, land, building, machineries, and equipments. And these assets do not come for free. Corporations need to pay for them. And to pay for these real assets, corporations sells claim on those assets. And those claims are called financial assets or securities. For example, bank loan, bonds, stocks. Take bank loan as an example. Bank provides the corporation with cash in exchange for a financial asset, which is a corporation's promise to repay the loan with interest. An ordinary bank loan is not a security because it is held by the bank, but it cannot be sold in the financial market. On the other hand, corporate bond, if you take it as an example, is a security because corporation sells the bond to investors in exchange for the promise to pay interest on the bond and to pay off the bond at its maturity. And as I said, that bond is a security or a financial asset because it's can be sold or it can be traded in financial markets. So other securities can be stocks or can be derivative securities we will be discussing later. Now, when we say investment decisions or financing decisions, what do we actually mean by them? Well, to be simple, investment decision is a purchase of real assets and financing decision is sale of financial assets. But I know that these equations are too simple. Investment decisions also involves managing assets already in place and deciding when to shut down or dispose of assets if those assets are not generating sufficient profits. Corporation also has to manage and control the risk of its investment in different assets. The financing decision, on the other hand, includes not just raising cash by issuing securities, but it also involves meeting obligations to banks, bondholders, and stockholders that contributed financing to the corporation in past. For example, a corporation has to repay its debt when they become due. If it cannot do so, it ends up insolvent or bankrupt. Last of all is a capital structure decision. We will discuss more detail later. That capital structure decision is a decision that involves the proportion of debt and equity a firm uses in its capital structure. Investment decision is also sometimes known as capital budgeting decision. Capital budgeting decision because most large corporations prepare an annual capital budget listing the major projects approved for investments. So capital budgeting typically involves purchasing of real assets, for example, land, building, machineries, or equipments. You know that today's capital investment generate future returns. Often these returns come in distant futures. That's why a finance manager must pay attention to the timing of project returns, not only their cumulative amount. In addition, these returns are rarely certain. A new project could be a smashing success or a dismal failure. And of course, not every investment has such distant payoff. Some investment sometimes may be only short-term consequences. For example, Walmart spends about a huge amount of money to stock up its warehouse and retail stores just before Christmas holidays. As the goods are sold over the following month, the company receives this investment in inventories. Finance managers do not make major investment decisions in solitary confinement. They may work as a part of the team of engineers and managers from manufacturing, marketing, and other business functions, and also do not think of finance manager as making billion-dollar investment on a daily basis. So capital budgeting decisions are very important decisions for a company, and finance manager must take care in terms of the risk associated with this investment and timing associated with the returns generated from this investment. So capital budgeting can, as I said, involve in investing in tangible assets, maybe involve in investing in intangible assets, for example, research and development. So as I said that a corporation can raise money from different stakeholders, maybe from lenders, maybe from shareholders. If it borrows, the lenders contribute the cash and the corporation promises to pay back the debt plus a fixed rate of interest. On the other hand, if they raise money from shareholders, shareholders put up the cash, but they do not get any fixed return. They hold the shares of a stock and they get a fraction of future profit of the company. The part of profit that shareholders receive is called dividend. Shareholders are therefore called equity investors, and the fund they put up to a company is called equity financing. The choice between debt and equity financing is called capital structure decision that I discussed in a slide before. Capital refers to firms' sources of long-term financing, both debt and equity. The financing choices available to large corporations seems almost endless. Suppose the firm decides to borrow. Should it borrow from a bank or borrow by issuing bonds that can be traded by investors? Should it borrow on a 1 year or a long-term basis? If it borrows for a long-term basis, should it reserve the right to pay off the debt early if interest falls? As far as equity financing is concerned, corporation can raise equity financing by two ways. First is they can issue new shares. Investors who buy these new shares put up cash in exchange of a fraction of corporate's future profit, that as I already mentioned. Corporation, rather than issuing new share, also can reinvest their cash generated by the operation. That means rather than distributing profit to shareholder as dividend, they can retain this profit and they can reinvest. That's another source of equity financing for a company. So what happens when a corporation does not reinvest all of cash flow generated by its existing asset? It may hold the cash in reserve for future investment, or it may pay the cash back to its shareholders. In some ways, financing decisions are less important than investment decisions. Financial managers say that values come mainly from asset side of the balance sheet. So in fact, the most successful corporations sometimes have the simplest financing strategies. For example, Microsoft, they have only debt and equity rather than having any other alternative sources of funds in their capital structure. Financing decision may not add much value compared to good investment decisions, but they can destroy value if they are stupid or if they are ambushed by, say, some bad news. For example, Sam Gell led a buyout of the Chicago Tribune in 2007 in United States. The newspaper took on about 8 billion of additional debt. That was not a stupid decision anyway, but it did prove fatal because the advertising revenue fell away in the recession of 2008 and the Tribune could not longer service the debt, and in September 28 it filed for bankruptcy of assets of 7.6 billion with a debt of 12.9 billion. So businesses are inherently risky. Finance managers need to identify the risk and make sure that these risks are managed properly. So these are some examples of some investment and financing decisions were taken by some big companies. For example, Facebook acquires WhatsApp for $22 billion. Fiat Chrysler announces plan to spin off its Ferrari luxury car unit. Walmart plans to invest 1.2 to 1.5 billion in e-commerce and digital initiatives. So these are some investment decision. And for example, some financing decision like Facebook pays for the purchase with a mixture of cash and Facebook shares. Fiat Chrysler repays 2.5 billion euros of medium-term debt. ExxonMobil reinvests $17.8 billion of profit. Now, let's take a very small and simple exercise. So the following are some examples, and we need to say that whether it's an investment decision or financing decision. For example, Intel decides to spend 1 billion to develop a new microprocessor. So it's definitely an investment decision. Volkswagen borrows 350 million euros, of course, a financing decision. Royal Dutch Shell constructs a pipeline to bring natural gas onshore from a production platform, investment decision. Avon spends 200 million euros to launch a new range of cosmetics in European market. So it's an investment decision. And Pfizer issues new shares to buy a small biotech company. So it's a financing decision.